In this video, we're going to talk about Smiledirectclub, trading under the ticker symbol SDC. The stock is a remote service platform to offer braces and essentially what your favorite or most hated dentist used to do after you put down something like $6,000 to $10,000 of down payment. And what it proposes are more low profile than conventional braces and arguably cheaper as well. Fundamentally, I think that the technology will still need some time to mature, even if right now there are already plenty of people willing to take it. I think that market potential here is that in time, people will begin to be more willing to try different alternatives of braces, and this is the appeal of the business and why it's valued in billions of dollars of market cap. Recently, the stock was under some serious short interest and triggered the attention of retail investors who believe that there is a short squeeze play. According to a person called Will Mead, who presents himself as a former hedge fund manager, SDC is one of the more shorted stocks in the market at the moment, after SPRT and BGTV, because approximately 40% of its float is currently been shorted, which presents a huge potential of reversal if the shorts are not enough to push the stock lower, because at some point they have to recover. So the play in this case is really on two levels. First of all, the company is offering something that I can imagine that will become bigger over the next couple of years or even decades. The need for adjusting teeth is there and is here to stay. And the demand for more affordable options compared to the current ones is also very present. This leaves the stock in a position of strength for the years to come. The second consideration is that right now, SDC stock isn't going up substantially. This means that despite an increase in interest, which by the way can be seen in the huge uptick in trading volume, the share price of SDC hasn't gone up yet. And that means that the stock can present a very interesting short squeeze opportunity if the entry point is before any significant share price increase. Now, don't get me wrong. These conditions simply mean that there is a high probability for the stock to go higher. It doesn't mean that it'll certainly go higher. There's always a chance that the company will keep trading sideways or worse still, grind lower because of the short sellers' pressure. We have to keep in mind that many household names like GameStop, their shares were shorted by hedge funds for years before the tide was finally reversed, and that the share price broke away from the downward spiral. In this context, the most important thing to keep in mind is to control our exposure, how much we're willing to risk, and even to lose, if the stock price direction doesn't go the way we hoped it would. And remember, there are a myriad of reasons why it may end up like this, regardless of the rational reasoning we can put out there. The simple fact of the matter is, there is always this possibility that the trade may go wrong. Normally, I would recommend to buy this kind of stock in waves so that you can increase your position gradually. But in this case, I think that if there's a good entry point, it is now. The only thing to watch out for is to be disciplined in the exposure and to not go over the limit that you've set for yourself, even if the stock goes higher. Keep in mind that the goal of trading is to make sure that your account balance keeps growing. This requires a leveled head at all times, and it can be negatively impacted by constant urges to check where the price of one particular position is at. That will completely scramble your attention, the rationality of future choices, and the quality of other trade decisions, not to mention the opportunity cost caused by the funds being put into this stock instead of other stocks. Overall, my recommendation is to buy and control your exposure within 1% of your portfolio. The timing of the trade should be within 2 or 3 weeks, and to exit once the share price has gone through a significant growth phase, like above 30 or 50%. On the other hand, if the stock doesn't really move within a few weeks, then it means that the interest generated so far is not enough to push the stock price up, and in that case, it may be wise to reduce the position size. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.